Did you know that one of the world's wealthiest individuals, Warren Buffett, made a significant portion of his fortune not just from picking stocks, but from the dividends they paid? Yes, the dividends, often overlooked, yet a cornerstone in the empire of the Oracle of Omaha. In the high-stakes game of investing, where flashy stocks and rapid trading often steal the spotlight, a quieter yet incredibly powerful strategy has stood the test of time. This strategy isn't about quick wins or betting on the next big thing. It's about patience, insight, and the subtle art of understanding value. So in today's video, we dive deep into Warren Buffett's philosophy on dividends and why he considers them the key to investing success. So, what makes dividend investing so unique? And how can you, as an investor, harness the power of dividends to build your own path to financial success? Let's find out. So, you know how some companies make a profit, right? Well, sometimes they decide to give a chunk of that money back to their shareholders. That's what we call a dividend. For example, if a company distributes dividends at $1 for each share and you have 10 shares, you'll receive a total of $10. The actual amount each shareholder gets varies based on their shareholding in the company. When a company pays out a yearly dividend of $1 on a stock that cost $100, this equates to a dividend yield of 1%. Let's break down Buffett's fundamental principles to understand how he picks those golden stocks that keep on giving. First things first, Warren's like a detective when it comes to a company's dividend history. He says, "Show me a company that's been upping its dividends and earnings consistently over the last 5 years, and I'll show you a potential winner." It's all about long-term performance, not just one-hit wonders. And if a company has kept its dividends strong even when the economy's been shaky, that's like finding a sturdy ship that sails smoothly through stormy seas. Now, let's get under the hood. Buffett doesn't just stop at shiny profit numbers. He digs deeper into sales revenues and cash flow. Why? Because sometimes profit numbers can be a bit of smoke and mirrors. You know, a company might look profitable because it cuts costs, but that doesn't mean it's growing. Warren's looking for companies that are really firing on all cylinders, good sales and solid cash flow. And here's the real deal, looking for companies with a competitive edge. It's like a game of King of the Hill in the business world. According to Buffett, the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. Companies that have been outperforming their competitors and have something unique going for them are the ones Buffett bets on. It's not just about being good now, it's about staying good in the long run. Like a restaurant that's always packed because they've got the best tasting dish in town. Buffett's got an eye for spotting undervalued stocks. It's like he's at a giant yard sale looking for high-quality items everyone else has overlooked. These stocks are from solid companies that, for some reason, aren't the flavor of the month with investors. They're trading at prices that don't reflect their true value. Think of it as a designer dress in a discount bin. These stocks have attractive price-to-earnings ratios and are often valued lower than the company's actual assets. Buffett's trick here is combining quality with value. It's like he's saying, just because it's not popular now doesn't mean it won't shine later. An underrated but high-quality stock is like a hidden masterpiece waiting to be discovered and appreciated in value over time. And then there's the jewel in Buffett's crown. Investing for the long term. He says someone's sitting in the shade today because someone planted a tree a long time ago. Buffett treats investing like planting a tree. You don't do it for the fruit you'll get next year, you do it for the abundant harvests in years to come. This approach is all about letting your investments reach their full potential. The perks? Oh, there are plenty. First, there are compounded returns. It's like a snowball effect, where your earnings keep generating more earnings. If you reinvest your dividends, primarily through a DRIP or a dividend reinvestment plan, You're essentially putting your profits to work, and they start earning for you too. It's an automatic process. Plus, holding onto your stocks for the long haul will sidestep hefty capital gains taxes and keep transaction costs low. It's a bit like buying a quality car and keeping it for years. The value you get over time far outweighs the initial cost. Now, let's zoom in on Berkshire Hathaway, the investment juggernaut steered by the legendary Warren Buffett. Here, the figures are nothing short of astounding. Berkshire is expected to rake in a whopping $6 billion dividend income this year. What's more intriguing? Over half of this massive sum is projected to come from just 4 renowned companies. This fact alone speaks volumes about Buffett's investment acumen. Buffett's tenure at Berkshire Hathaway is a story of remarkable success, spanning 58 years and an incredible 4,300,000% increase in the value of Berkshire's Class A shares. This isn't just a success story, it's a masterclass in investment. Under Buffett's guidance, Berkshire has not only outperformed but doubled the annualized total return, including dividends of the S&P 500. Books have been written dissecting his core philosophies, thinking long-term investing in great businesses with sustainable growth drivers at fair prices. Yet, one aspect of his strategy that doesn't get enough spotlight is his preference for dividend stocks. Why are dividend stocks so crucial to Buffett's strategy? These are typically companies that have stood the test of time, consistently profitable and reliable. Historically, stocks that pay regular dividends tend to outperform non-dividend paying stocks in terms of total returns. This preference is evident in Berkshire Hathaway's portfolio, which is heavy on dividend-paying stocks. Nearly $3.5 billion, more than half of the expected $6 billion in dividend income, is anticipated to come from just 4 of these stocks. When it comes to their portfolio, it's a masterclass in strategic investment, particularly evident in its top dividend-earning holdings. Let's start with Bank of America, Berkshire's powerhouse in the banking sector. It's not just a holding, it's a dividend juggernaut. Picture over 1.03 billion shares, each contributing to a mind-blowing $992 million in dividend income this year. It's like owning a golden goose that just keeps laying those dividend eggs. But why does Buffett bet big on bank stocks, especially B of A? It's their cyclical nature, tied to the economy's ebb and flow and the evergreen need for financial services. Sure, banks have rollercoaster moments during recessions, but economic expansions tend to last way longer than downturns. Buffett isn't playing the risky game of timing the market. He's strategically positioned in quality stocks like B of A that thrive in extended periods of growth. And here's a kicker. Bank of America is like the weather vane of the banking world. Super sensitive to interest rate changes. B of A feels it the most when rates shift, making it a unique player in Buffett's portfolio. Next up, let's talk about Apple. This isn't just another tech stock, it's the crown jewel in Berkshire's tech investments, accounting for a whopping 49% of the company's invested assets. Apple stands as Buffett's tech darling. And the dividends? A staggering $15 billion annually. It's like Apple is raining money into Berkshire's lap. But what's behind Apple's dividend superpowers? First off, its branding is unparalleled. According to rankings, Apple is the world's most valuable brand. It's got a fan base that's more like a family, fiercely loyal and constantly growing. Then there's the innovation factor. Apple isn't just playing the tech game, it's dominating it. Apple leads the charge from iPhones that have become an extension of our hands to iPads that have redefined tablets. And Apple is transforming into a platform-centric powerhouse, with subscription models that glue customers to its ecosystem while padding its profit margins. Then there's Occidental Petroleum. This energy stock is a dividend powerhouse for Berkshire. The numbers are staggering. $164.2 million in dividend income from nearly 228.1 million shares of common stock, all scooped up since 2022. But wait, there's more. Berkshire also holds a massive $8.49 billion in preferred stock, yielding an astonishing 8%, which translates to about $679.2 million in annual income. That's a hefty stream of cash flowing in from just one company. But why is Occidental such a darling for Buffett? It's all about the oil. With the expectation that the spot price of crude oil will stay above its historical average, Buffett is playing a strategic game. Factors like the ongoing Russia-Ukraine conflict and a pandemic-induced investment slump in the energy sector mean that crude oil supply will likely remain tight. And for a company like Occidental, which gets most of its revenue from drilling operations, higher oil prices mean more cash flow. It's like having a golden goose that benefits extra when the oil market shines. Now let's pop the cap off Coca-Cola. This isn't just any beverage stock, it's a dividend legend. Coca-Cola has been upping its dividend game for 61 years straight. Talk about consistency. It's Berkshire's longest-held stock, a relationship fizzing since 1988. But what makes Coke such a reliable income generator? Coca-Cola is the quintessential consumer staple. No matter what's happening in the world, good times or bad, people need their food and drinks. This means there's always a steady demand for Coke products. Add to that its killer branding, topping its brand footprint for a decade, and you've got a recipe for success. Coca-Cola's branding isn't just good, it's legendary, connecting with audiences young and old across the globe. Plus, its global presence is unmatched, making it a diverse and resilient income source for Berkshire. These four giants, Bank of America, Apple, Occidental Petroleum, and Coca-Cola, are the backbone of Berkshire's dividend strategy, collectively funneling billions into its treasure chest annually. As we wrap up, are you ready to explore the potential of dividend investing in your portfolio? How will you apply the lessons from the Oracle of Omaha to your investment strategy? Let us know in the comments section, and thanks for watching.